If you're a real estate professional or managing a short-term rental, then you've probably seen online well-known accountants that say travel time doesn't count toward your material participation hours. Even Google's AI gives us the answer that travel time doesn't count. But in this video, we are going to go through the actual tax law, which is over 30 years of tax court cases, so you know why and when they're dead wrong. The case law analysis in this video will tell you when you can count your travel time hours toward material participation, and I'm going to give you a free pre-written legal memo that has the exact law and argument that you need in an IRS audit, since now you will likely know more than your IRS auditor about the law in this area after watching this video. And if you don't know me yet, I'm Jasmine DiLucci. I'm a tax attorney, CPA, and enrolled agent. And I recently got into social media, even though my day-to-day is actually running my CPA firm and my tax law firm, but I do it to show you actual tax law. So before we get into some very detailed tax law, it's important we understand the foundation of tax law. We have our three main levels, okay? Statute at the top, then Treasury regulations, and then court cases. The least amount of detail and guidance is usually in the statute. So even though it is at the top, we almost always have to look to Treasury regulations and court cases to get the majority of the information and detailed interpretation. And if you already know my content, then you know that what your accountant, or even honestly what the IRS auditor thinks the statute should mean doesn't matter. It is what Treasury and tax court says that it does mean that does matter, and that's what the IRS is required to follow. And an accountant who does not know how to do tax research to look up Treasury regulations and court cases cannot tell the difference between a gray area and a gap in their knowledge. Now, for this topic, we don't have clear statute or Treasury regulations addressing travel time, but that doesn't make it a gray area, because once we have enough court cases, we begin seeing the clear rule set out by tax court. Travel time in real estate or business, it's not a new concept, okay? We have a bunch of cases to cover to determine when travel is a part of material participation hours. So let's start with what so many accountants, so many blogs, and even Google's AI looks to for their strongly stated position that you can't count travel time toward material participation. They look to the IRS Audit Technique Guide. Okay, these guides are published publicly, and they provide guidance for auditors to use in IRS audits, because tax law is hard for everyone, including the IRS, and these guides help the auditors understand the law without having to do actual tax research in the middle of an audit. The guide is supposed to summarize the current tax law, but like anything that is written by a very biased party, it may conveniently exclude things that are favorable to you and include things that are more opinion than fact. So, what does the IRS's Audit Technique Guide on passive activity losses say on travel time? It says, travel time generally should not be considered in computing the hourly tests for material participation, particularly if other factors indicate the taxpayer is not participating in the activity on a regular, continuous, and substantial basis. Legislative history provides that services must be integral to the operations. Then the IRS inserts their opinion. They state, it is somewhat difficult to construe that travel constitutes services or participation as contemplated by Congress or the regulations. More importantly, travel is not integral to operations in most cases. Then there's a citation to show the law that they are supposedly relying on for this paragraph, which says, we have no express statutory guidance on travel, while not precedent setting and just a summary opinion, right? So that's them admitting that they are relying on very weak support. The following case provides guidance on travel time, Truskowski, Tax Court Summary Opinion 2003-130. So the reason a tax court summary opinion on its own is very weak support is that, as tax court explains on their website, they cannot be relied on as precedent, and the decision cannot be appealed, and that's because it's a part of an expedited procedure for small tax liability cases. So when they're in the context of other cases with which they are consistent, they can be persuasive, but they're not legal precedent. Why shouldn't we just blindly follow this IRS Audit Technique Guide? Well, first off, it was published in 2005, so it is almost 20 years old, missing 20 years of tax court cases, and even more importantly, the guide itself has been marked obsolete by the IRS. Even if we were back in 2005, an IRS guide is not authoritative guidance in the first place, and the only citation they provide is to a case that is also not authoritative guidance. So, what do we do when we have adverse and outdated IRS guidance that is not law? we look to the actual tax law that the IRS is supposed to follow, which is the court cases. So here's the plan. We'll go through the 4 court cases that were published before the Audit Technique Guide so you can see how the IRS was able to misconstrue the rule given the limited amount of cases at the time, and then we'll go through the rule that we can extract from the last 30 years of court cases when analyzed together with the case law support so that you can see exactly what you need to do to fall on the side that allows you to count your travel time. First, we have Toops v. Commissioner, a 1993 tax court memo case. Remember, the material participation regulations came out in the late 1980s, so we now just start to see court cases around this time in the 1990s. This taxpayer, who was a full-time engineer, purchased a short-term rental over 8 hours away from his home in a resort area. He claimed he materially participated in the property, even though he signed, what? A 30-year rental management property agreement. So not only did he not manage the property himself, but he included 32 hours of travel time on his log for him and his wife. And you might be thinking, well, if they weren't managing the property, then why did they travel there? Great question. For vacation, 14 days each year. Travel time was denied by the court, with them saying that even if they did some work at the property, it would have been incidental to the primary purpose, which was vacation. Next, in the same year, we have Goshorn v. Commissioner, a tax court memo case. Same year, same lesson. This one involved a charter boat for rent in Dallas that was managed and operated by the marina. The owner would travel to Dallas on business for his employer 14 times a year and would also visit for vacation 2 weeks a year. And what did he do? He counted the travel time for his vacation and for business trips for his employer as material participation hours for the rental by stating he spent something over 300 hours traveling from Connecticut to Dallas, a statement he also made without a log or any proof whatsoever. So what happens next? You don't need to be a tax attorney to guess. The court denies the travel time and says, the most that can be said about this time is that it was spent on an investment-related activity rather than the charter business, and cites back to our Toops case. Note that neither of these cases said that travel time can never be counted, just that the taxpayers didn't even prove they participated in any management activities in the first place, so the hours traveling to go, not manage the property, was also not going to count. Next, let's go to a 2002 tax court memo case, Shaw v. Commissioner. In Shaw, the court included travel time as a part of material participation, which was 110 hours out of the total time spent of 418 hours. Why did they do that? Because the taxpayer did actually have participation in the activity, and he also had great support. The court says the trips he took in his airplane are documented in his airplane flight log. The airplane flight log recorded the dates of travel, points of departure and arrival, hours of flight duration, and remarks on the purpose of the trips. Simple as that. He participated in the management of the business, and he kept the proof. The only reason that the taxpayer still lost in court is because even though they counted the travel time, he didn't get over that 500-hour material participation threshold. Fourth, we have the only case that the IRS chooses to acknowledge in the travel time section of their 2005 Audit Technique Guide. This is Truskowski v. Commissioner, a 2003 tax court summary opinion. The other 3 court cases we just covered either imply that travel could be counted under certain circumstances, or they explicitly count the time, like in Shaw. Yet here we are with the one biased citation from the only case that is not legal precedent at this point. In this case, the taxpayers were full-time employees at a computer software company, and they also had a cattle breeding activity, okay? So they boarded the cattle at a farm and had a local farmer manage the cattle. Despite the taxpayers keeping a log of activity over 750 hours per person, the court threw out a significant amount of investor time because, of course, they were not involved in the day-to-day management. And the differentiator for this court, which made this a great case for the IRS to cite, is that they also threw out the travel time to and from the farm, calling it personal commuting. So a reminder, not all travel time was even disallowed in this case, okay? Yet the IRS extrapolated the conclusion that all travel time is generally not counted for their guide. But even then, if you know anything about personal commuting, then you know that if you can establish a home office as your principal place of business, then your travel from your residence to your other work location becomes business travel. The taxpayer didn't do that in this case, and I mention it specifically because you're going to see this come up in another more recent case where the taxpayer was successful by establishing a home office, and we'll get into more detail on home office with that case. So let's do a recap on these cases, okay? Remember, the IRS enforces the law, it does not create the law. So at this point, before the 2005 Audit Technique Guide is published, we just don't have too many cases on travel time for material participation, even though in my opinion, we still have good evidence, okay? But because of the limited cases, the IRS took a very blanket opinion on travel time in their guide based on what existed by citing the only favorable case for the IRS. But it is now 20 years later since the guide has been published, and as a reminder, the guide has since been marked obsolete by the IRS. So let's dive right into the rule we can extract from the last 30 years of court cases when analyzed together. And remember, I'm also going to be giving you this law in a pre-written legal memo with court case citations. Based on the court cases, here's the 4 criteria to meet for counting your travel time in your material participation log. 1, meaningfully engage in operations. Okay, 2, travel to the property with the primary purpose of meaningfully engaging in the operations. 3, keep credible support to show that you actually meet criteria 1 and 2. If you think you meet criteria 1 and 2, but the IRS or tax court can tell that you're full of shit, you're going to lose the entire case, not just travel time. And finally, you want to keep proof of a home office in case the IRS tries to claim to and from your property is personal commuting in order to disqualify the hours on your log. Let's go over the support for criteria number 1, which is that you need to meaningfully engage in the operations. So we already went into detail on both the Toops case and the Goshorn case. If you only participate in investor activities, which we know don't count for material participation, then to travel to go do those investor activities is also not going to count, okay? Point blank period, you pretending to have useless meetings that have no substantive meaning to the operation itself so that you can have an excuse to drive and vacation to the property won't work. Like in Toops, where the court saw that an HOA meeting was created on the recommendation of the association's CPAs after the passive loss activity rules were passed. The court said that the annual meetings are superficial and do not materially change the operations or management of the cottages before disallowing all of the taxpayers' time log and finding the activity passive. So one more case that's a great example of the court calling bullshit on the hours in the log, resulting in the travel time also being thrown out, is Gende v. Commissioner, okay? The taxpayers owned condominiums and of course had a management company handling the day-to-day operations. You're probably starting to see a theme there. Okay, the court looks at the time the taxpayers logged as a result and then proceeds to make fun of them for several paragraphs. The court goes into day-by-day detail of how the taxpayers went marathon shopping, okay, and spent 80 hours each, so a total of 160 hours in their log across only 8 days shopping for condominium decorations and household items. The court says that is a lot of shopping before finding that they do not meet the requirements and also stating that the travel to their properties was not integral to their operation and will not be considered work for purposes of determining their material participation in the condominium. Because why? The taxpayers literally drove to the properties to do activities that appear on their face to be unbelievably unnecessary to the property, if not just a straight up lie. So one case where the court found that the taxpayer did meaningfully participate in the operations was Shaw. They stated the petitioners took trips for the purpose of improving his business operations, okay? It was a simple case. The taxpayer worked on the business operations, so the travel time was counted. We have the same result with the more recent case, Leland v. Commissioner, a 2015 tax court memo. The taxpayer won that he materially participated in his farm, even though he was a full-time attorney, okay? But the taxpayer would drive about 13 to 16 hours from Mississippi to Texas and back several times to perform necessary work. He would hunt wild hogs, clear vegetation, control trees and brush near the roads, plant wheat, and maintain the fences and farm equipment. The court found that he met the threshold of 100 hours plus more than anyone else. Travel time wasn't even in dispute in the case, meaning that the IRS allowed inclusion of it before even getting to court, and despite that, the court goes out of its way to say that the travel time was appropriate to include in the log because the facts of the case establish that petitioner's travel time was integral to the operation of the farming activity rather than incidental, citing back to our Shaw case. So a recommendation, since it's a clear common denominator in our line of court cases, is that for there to be meaningful operations left for you to do, you probably shouldn't have an amazing management company that does everything. Next, let's go over the support you need for criteria 2, which is that you need to travel to the property with the primary purpose of meaningfully engaging in the operations. So honestly, this one's pretty straightforward. We know that the courts care about the legislative intent when the statute was drafted, which said that the time should be integral to operations. So like in Leland, where the court says the facts of the case established that petitioner's travel time was integral to the operation of the farming activity rather than incidental, right? So incidental would mean you're really going there for vacation or because your mom's in the area and oopsie, we stopped by the property. Instead, you want to be going there with the intent of working only on the operations. And when we look at all these other court cases, right, you look at Toops, Goshorn, Shaw, Lee, Leland, Gende, if the court believed the taxpayer went to the property to do meaningful work, they counted the taxpayer's travel time, and if they believed you really just went there for some other reason, or worse yet, with the purpose of manufacturing material participation time, then they didn't count it. Next, let's go over criteria 3, okay, which is that you need to keep credible support for the first 2 criteria. So I think you already know that you need to support any tax position you take, right? So the burden of proof is on you to prove your position always. But that's especially true when it's something that can so easily be made up, like a self-created log of your time. The IRS and tax court will extract your credibility based on your support. They don't just presume any hours you logged are correct. They look to the facts and circumstances, right? They look to, was this log created in real time? Does the log have things listed that make no sense, like working multiple 19-hour days, like in Jafarpur, where she had illegible entries, ambiguous entries, logs with inconsistencies, and activities that appeared excessive compared to the time spent, or like in Lucero, where the taxpayer claimed to drive to the property 6 to 9 times a year to manage it, even though he had a management company in place, and the log was filled with tasks that appeared to be excessive in relation to the task described. If the court doesn't believe you, they will throw out your hours logged, including the ones for travel. So in Lucero, the court says, the log itself is not reliable and therefore is not a reasonable means of establishing material participation hours, so they threw it all out, including the travel time. An important case where the taxpayer did have support for both meaningful operations time as well as the travel time incurred was Lee v. Commissioner, a 2015 tax court summary opinion. The taxpayer's material participation case was dependent on whether the travel time hours were included. The original log didn't even include the travel time, probably because she got the wrong advice, but the taxpayer later added in the travel time hours. Despite the IRS very strongly arguing that the taxpayer did not materially participate, the court differentiated her case from the other cases cited by the IRS by saying those cases did not involve a detailed contemporaneous log such as the one petitioner maintained. Petitioner provided day-by-day explanations of the specific rental real estate activity in her log. Further, from the log, it was easy to identify which days took place in Austin. Finally, petitioner has shown that the travel time was not included in the original log. The court at one point refers to the taxpayers having clear and crisp recall of the activity reflected on the log. And of course, this also applies to Leland and Shaw, where the taxpayers had support for both the meaningful operations time spent as well as the travel time incurred, so the material participation hours, including travel time, were counted. Finally, let's go over why you should keep proof of a home office just in case the IRS tries to claim to and from your property as personal commuting in order to disqualify the hours on your log. So let's revisit the Truskowski case, okay, which was the 2003 summary court opinion that the IRS clings to in their outdated and obsolete audit technique guide when trying to disallow travel time across the board. The court in the Truskowski case did deny the travel to and from the property, calling it personal commuting. But we know that when you establish a home office as your principal place of business, your personal commuting becomes business travel. And how do we know that? Because the IRS says it does very explicitly in Revenue Ruling 99-7 And by the way, it is labeled 99-7 because it was published in 1999. So what is almost certainly the case is that Truskowski had bad tax representation since no one thought of the idea to establish a home office, and let's be honest, they were probably on a budget, which is why they went the expedited tax court route, resulting in a summary court opinion that could not be appealed. But you know who had better tax representation? Tresiak. In this case, a 2012 tax court memo, the taxpayers had 14 single-family homes, and the wife would qualify as a real estate professional as long as the travel time to the property was included. Once the CPAs and attorneys brought up that there was a home office as an argument at IRS appeals, so it wasn't even on the original return, okay? The IRS allowed the travel time to count as a part of the log. The actual court case is pretty funny because the taxpayer then goes on to pursue the IRS for attorney's fees, arguing that the IRS position wasn't substantially justified, but they lose the court case because tax court found that it wasn't the IRS's obligation to ask about whether there was a home office. It was, of course, your job to show that you have one. Now, a home office is for a trade or business, not a mere investment, but if you're meeting criteria 1 and 2, you should already be there since you would have met the standard for showing material participation in your activity, which by statute is involvement in the operations of the activity on a regular, continuous, and substantial basis. So what takeaways do we have if you want to count your travel time? It's pretty straightforward. 1, actually participate in the operations and do not hire a property management company. If you do not have actual material participation that counts in the first place, then your travel time is also not going to count. 2, travel time should be for the purpose of working on the operations. It should not be so that you can vacation or visit your mom while pretending that you went there for a business purpose. 3, you want to be credible. If the IRS or tax court thinks that you are a liar, then they are going to check out your travel time hours along with the rest of your log, so have actual proof of hours that actually provide value to the property. Finally, you want to keep a home office just in case. If the IRS tries to argue personal commuting to and from the property, then showing a home office should convert it to business travel. So there you have it, the actual tax law. But now you're like, well, Jasmine, what do I do if the IRS doesn't know the actual tax law and they think travel time shouldn't be included in my log? Should you hide in fear and roll over like a dead duck in an IRS audit? No, IRS auditors get the law wrong all the time, even when you're on solid legal ground. Instead, you should download my free legal memo linked in the description below, outlining the law we just covered. This is actually the type of submission I create and use successfully in IRS audits whenever there's an area of law that supports my client's situation and the IRS just isn't familiar, which, by the way, is more common than you would think. So you just want to make sure that you show how your facts meet the criteria we outlined and match the winning cases. Now, I also always want to leave you better off to get real tax answers, since I'm now telling you how your CPA and even Google can fail you. So I reached out to one of the most legit CPAs that I know, Murray Bradford, asking if I could do a giveaway for 3 one-year subscriptions to his amazing tax resource that I use daily. And to be clear, not a sponsored post. I have not done any sponsored posts intentionally. I only recommend what I actually use, and I genuinely use his incredibly affordable tax subscription for very difficult research questions, and it kills me to see people paying tens of thousands of dollars for the wrong answers. So on this video's topic, if you had used his tax subscription in a 2-minute search, you would have seen an incredible article on when travel time can count on your hours log with citations to actual law. So here's how to enter the giveaway. All you have to do is 1, subscribe to my YouTube channel. 2, you want to sign up to receive my free legal memo. And then 3, you can respond to the email that you get with my free legal memo with one topic that you're requesting for me to include in my 2025 free tax workshops so that we can build a tax workshop calendar around the most requested topics. You will then be notified via email if you win, and we'll announce on Instagram once the winners have been selected. And as always, if you like this video and you have as much fun as I do learning about tax court cases and want to see more like it, then comment and let me know. That is actually how I know what type of content you want me to make. And as always, for actual tax law from a tax attorney, CPA, and enrolled agent, subscribe.